Retail lending by banks comprise home mortgages, loans to buy motor cars, personal loans, credit cards, and so on and so forth. These loans are relatively smaller in value, however, encompass a large number of customers, usually running into several thousands. Consequent advantage in managing risk in retail lending is the absence of what we refer to as concentration risk. That means too much money being lent to one customer. Remember, in retail lending, it's distributed across several customers. Furthermore, given the large volume of loan applications that need to be processed, automated credit scoring models are deployed to evaluate and approve loans. One such scoring model is enumerated in a spreadsheet to follow. An important piece of information elicited by the lender from the loan applicant when evaluating a retail loan is the loan applicant's repayment obligations on the loans that he may have already sourced from other banks or lending institutions. This would include his existing mortgage payments, payment against credit cards outstanding, repayment towards other personal loans, etc. In fact, one of the important parameters in the credit scoring model is the total debt service coverage ratio, or TDSCR for short, which is arrived at based on the potential borrower's annual current debt repayment obligations in the numerator divided by his or her current gross annual income in the denominator. The assessment is also based on the demographic profile and the financial standing of the loan applicant. In other words, what is his income and expenditure pattern as of now, as well as the credit score obtained from credit bureaus such as Equifax, TransUnion, etc., about the loan applicant's current level of debt and track record of repayment. As you might already be aware, credit bureaus are a repository of loans provided by virtually all banks and lending institutions to individuals, as well as the repayment track record of every individual against those loans that he would have taken. Credit bureaus use fairly sophisticated statistical models to compute the credit score for every individual on their database based on the above data and make it available to banks as and when needed. The credit scores obtained from the credit bureau for the loan applicant serves as an additional input to the credit scoring model used by each lending institution. We will now look at a spreadsheet that shows you a sample credit scoring model, the parameters used in the credit scoring, and the associated weighted scores. May I reiterate, this is only a sample. Each lending institution would use parameters and weightages based on its own past experience of lending and the analytics that it has gathered with all the data on past lending. So here are the parameters we have chosen in this credit scoring model: the annual gross income of the loan applicant, his age, academic credentials, current debt service ratio, which we looked at a little while ago, the scores received from the credit bureau, which is also called the FICO scores, whether he's got any credit cards, what's the nature of his current relationship with the bank from where he's seeking a loan, his current residence, is it his own property, is it on mortgage or is it rented, length of service in the present job, and a total of that would be the maximum possible score. Now, as you can see on the x-axis, on the gross income, anybody who has a salary less than 100,000 gets a score of 0, 100 to 300,000 a score of 10, 300 to 500,000 a score of 20, 500 to 1 million is 30, and greater than 1 million, a score of 40. In the same way, we have looked at every one of the parameters and given them weights. What's interesting to note here is if you look at the age parameter, less than 25 is 10, 25 to 35 is 20, 35 to 45 is 35, 45 to 65 actually reduces to 20, and greater than 60 reduces to 10. In other words, what we're basically saying is we prefer customers taking a loan in the age of 35 to 40. We don't like them taking a loan as they get older, particularly if it is a mortgage loan, because the period left for them to repay would be much shorter, and that's not very welcome by the bank. On all other parameters, you will find that the weightages increase as we go past the columns. So if a person has a current debt service ratio of less than 5%, in other words, no more than 5% of his gross income is his loan repayment obligation. In other words, this individual has very low leverage. The amount of loan he has taken is very, very small. So he gets a score of 50. Now let's map this set onto two customers of the bank, two loan applicants of the bank. Applicant 1, his salary is between 300 and 500,000. He's between the age of 25 and 35. He's an undergraduate. His loan servicing at the moment takes anywhere between 15 and 35% of his gross income. He has a FICO score between 600 725. He does have more than one credit card. He only has a savings account relationship with the bank. The present home he is living in is on rent, and he's been in his present job for between 1 and 5 years. Now, if we map these scores with the weightages on the left side of the spreadsheet, you find that this applicant gets a total score of 145, and since the maximum possible score is 300, his percentage score is 48%. There is a very high likelihood that this individual might not get the loan, and we will see why not in the next few minutes. On the other hand, if you look at applicant 2, he's a far more affluent applicant. His income is between 500 and 1 million currency units. He's in the age of 35 to 45. He's graduate or higher education. The loan servicing is very low. That means the amount of debt repayment obligation is very low. He has possibly a very high FICO score. He does have more than one credit card. He has a savings account, and he has other products sold to him by the lender. He's living in a rented house. He's been in his present job for more than 5 years, and as a result, his total score is 240, and in percentage terms, his score is 80%. Now, we can easily guess that a person who gets a score of 80%, i.e. 240 out of 300, will most likely qualify for a loan. As you would have seen in the spreadsheet that has just gone by, retail lending institutions have a cutoff discipline to evaluate loan eligibility. For example, the institution could have a rule that a credit score less than 150, as you saw in our spreadsheet example, will not be eligible for the loan. Credit scores greater than 225 will automatically be eligible for a loan. When the credit score is between 150 and 225, approving the loan is at the discretion of the lending institution and is usually determined by a committee that explicitly looks into the merit of every such case prior to approval.